Also, good evening, guys. Yeah, man. Hello.
Yes, good evening, everyone.
Yeah.
Evening, bros. How are you?
I'm okay. I hope everyone is fine and everyone has had a good trading day. Because yesterday was a bank holiday, but today was a normal trading day, so the markets were volatile. Though I've been kind of busy. I'm just from an online mentorship. I mean, one-on-one mentorship at Mapera building. I've just arrived home right now, so I was quite busy the whole day. I wasn't too much on chats, but then today I want us to discuss something that that everyone normally looks at, something that everyone normally tries to look at or tries to emphasize, and that is entry models. Today I want us to look at the entry models that we have and how we can use them to. Because I normally find people trying to ask me about entry models. Everyone wants to learn how to enter the market. That is everyone's aim. Everyone wants to learn how to enter the market. Everyone who joins the trading industry thinks of entering the market with immediate effect. So that is what I want us to try and discuss or try to digest today in this mentorship class that I've scheduled. But before we begin, we have a new member that has joined us. That is Mr. Fred Mugabe. He has joined us this evening. In fact, he joined us today like at 8 p.m. So, Mr. Mugabe, you're welcome. You're welcome to this mentorship class of ours where we normally sit down discuss the forex pairs and try to analyze as a group on a daily basis, normally from Monday to Friday. And there's also some information I want to pass across, starting from the first of next month. The first of next month is going to be a very busy month. Not only busy month, but starting from the first onwards, we shall be very, very busy. Reason being, I'm introducing a VIP channel. In fact, I will call it a Signal VIP channel. That is what I'm introducing on the first. Effective on the first, I will introduce in that mentorship VIP channel. We shall I will share like 3 to 5 signals a day. 3 to 5 signals a day is what I will share, and we shall be having live sessions where if the signal is forming, we shall wait for the signal together and we enter the market and we see how much pips or how much dollars we can get. That is a VIP live session. I used to have it some time back. That was I think at the beginning of last year. But I became so much busy in Feb, March. I became so much busy in the middle of the year. That is in June, July, April. I became so busy towards mid of the month until this Jan. I was kind of busy, but next month I'll be settled. I'll be settled for real business. That is a VIP signal channel. Real business, I'll be settled. We shall be having what up is forming. I'll organize a live session. We look at when we are supposed to enter and all those things, and we enter the market. Then after, we see how many pips we can get and manage in that session. So that is a VIP Signal VIP session. But we shall be having also the mentorship class. The mentorship class with the effective of next month, it will be at 9 p.m. It will be at 9 p.m. because I know by that time everyone will be home. At 9 p.m., everyone will be home and settled. So that is when we shall be having the mentorship class from 9 p.m. onwards up to around 10, 10:30, latest 11. That is the mentorship class. But during the daytime, we shall be there with the signal members. Shall be there with the signal members trying to see which signals we have for that day, which trades we can take for that day. At least 3 to 5 setups a day. So 5 sessions, the management, we have guidance in that. So those who want to join us in that live session, you inbox me and we discuss, because that is a very important package. That is, in fact, I introduced that package due to demand, the high demand. A lot of people wanted that package, so that package I've introduced.
Ambrose, there must be high demand for it. There must be demand. I know there will be demand.
People have been requesting me for that thing ever since. But then I couldn't because I was busy.
I foresaw it coming. I once asked you that question. Yeah, I once asked you a question whether I have VIP. This, you said no, you don't do it. I knew that one day people are going to request for it. How can you be entering 500 positions and you expect that no demand? Who does that? Nobody has ever done that in this Forex industry. 300, 500 positions. So you are doing something that nobody does. So definitely you expect such kind of demand now.
So you see, that is what we have to introduce. That is what we have to say. So even a testimony right from Nigeria has come. We have gotten a testimony from Nigeria. So we have to expand this. So those who are willing to join the Signal VIP channel, you inbox me and we talk. Starting from the 10th. I mean, not the 10th, from the 1st of next month. And the spot is limited. I need like limited people. I don't want many people. I want few people in the group. So I think I will take like 10 to 15 members will be enough, and we move forward in that thing. So that is beginning on the 1st of next month. So those who are interested, you hit me up in my inbox and we see a way forward. So before we begin the class, that was by the way, before we begin the class, if you have questions, you ask me, and I explain before we begin our topic of today. That is entry models. I'm seeing I'm seeing a new, I think, GM Forex Capital. GM Forex Capital, you can say hi.
Mr. Ambrose, good evening.
Yes?
GM
Forex Capital.
Yo.
This is the name. First tell me the name.
This is your...
Pardon?
This is Mr. Do Good.
Now you Mr. Do Good, the way you like changing names.
No, that's the name they just back time it now. Last time when we met.
By the guys, I was there with Mr. Do Good on the Derive Summit on Saturday. We were there chilling there.
Yeah, so the guys now give me...
Ambrose, I have a question.
Yes. You ask. You may ask.
Please, institutional order flow, entry model drill, type 1, type 2. I want to know about it. Institutional order flow, entry model, type A, type B. I beg. I really want to know about it.
Yeah, I will explain it I will explain it shortly. Order flow entry drill type 1, type 2. Type 1. Yes. Type 1 is where we have a pivot coinciding with a fair value gap. That is type 1. Then type 2. Type 2 is where we have a fair value gap opposite the fair value gap. That is it. I will explain more about it. So today I want us to let us begin the class, entry models. If someone has another question, you can ask before we begin the real class. Diana, do you have a question?
Good evening, Mr. Ambrose.
Yeah, good evening. Mr. Alex, right there from Nigeria, yes?
I want to ask a question. What is the difference between inducement and liquidity? What are the differences?
Okay, when we
Like,
talk of induce, yes, you have another
how,
question.
no, that's the only question I want to ask. Like, how can we just identify inducement from liquidity?
When we talk of inducements and liquidity, they're kind of similar, but they are not the same. They're similar, but they're not the same. An inducement, liquidity is created when the market induces people. Liquidity is created when the market induces people. So an inducement gives back to liquidity. For liquidity to be formed, the market must first induce people. The market must first tap on a zone, then it tries to move away. That is when the liquidity will be created. So liquidity comes after inducement. That is what I can say about that. Liquidity comes after inducement. Like if we have 2 points of interest on a given, setup, the market will first go and induce you on the first point of interest. After inducing you on the first point of interest, that is now creating liquidity. The inducement creates liquidity. So an inducement creates liquidity. So that is in simple terms the explanation I can make on that. Inducement creates liquidity. I hope I'm clear on that.
Yes.
Maybe to add on something.
Yes, Mr. James, Mr. Dogood.
Another difference that my experience has defined in the market is that inducement makes a trader to do something. It pulls you to act, to enter the trade, while liquidity does not do that. So when the price reaches, the price will come close to your zone, and it will not touch your zone. Then it begins to sell. Suppose the retracement has been buying. So it comes and approach your zone, and then it begin to reverse to the direction that you wanted to see. So you're supposed to just watch the play whatever is playing, because that is the point that retail traders begin to get induced. Because the word induce means tricking, lying to you that we are now going, but yet that is not an actual movement. And then eventually it comes and grab that liquidity, just like you have said that the inducement creates liquidity. And then eventually it goes to your directions. So mostly if you want to understand it, you must be watching the chart as is approaching your reactive zones. And I think to the new traders is the only thing anyone should understand from the market: liquidity and inducement. Then you are done.
Very, 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 very nice explanation there from Mr. James.
Mr. Ambrose,
That's
to
one
add
of
on,
the perfect explanations there.
Mr. Ambrose,
Actually,
to add on,
hello.
Yes.
Actually, I started understanding liquidity. I started understanding the market very well when I started having good knowledge of liquidity and inducement. Before, I used to see double top and double bottom, head and shoulder as a very good something. But I could remember when I say one day I saw a double bottom. I took a buy. Before I knew it, all my $50. And before I knew it, instead of going out, the thing took me down. After blowing my account, it started going up. And I was asking, why now? Sometimes you be thinking that if somebody is watching all these trade. Some traders used to believe in this, that they are manipulating, brokers manipulation. But it was when I knew about liquidity and this meant I started to have good knowledge about trading. That then when I want to have my point of interest, the first thing I look at is there liquidity under my point of interest or above my. If there's liquidity, I will know how to do my analysis. So I think it's another form of manipulation. That is one thing I think about it. If no trader, if you don't have knowledge of liquidity, that person also always fall a victim of the big banks.
Yeah, that is also a good experience right there. That's why I normally tell people that the most important concept in trading it is liquidity, followed by market structure. Because if you know liquidity, you can know where the market is going. And if you know market structure, it is good. But the market can sometimes mean to violate the market structure in a bid to hunt for the liquidity. So liquidity is very important, followed by market structure. And for you to observe all the things, you must be ever watching your charts. For you to observe it, you must always be watching your charts. Because once you watch your chart, you'll see what in the market. And in our VIP class, the Signal Mentorship VIP class, those who are interested to join, you'll see we shall be able to identify all those liquidity zones, because we shall be having, let's say, 2 zones. But I will organize a session, then I'll be like, now the market has approached our zone. Now let us wait and we see the inducement. If there is no inducement, then there is no entry. That is some of the things that we shall be digesting in that class of hours. And in that class of hours, I need like at least a maximum of 15 people. So a maximum of 15 people will be able to join the class, and we have the intensive discussion. So you must be able to know what liquidity is. That is the first thing. Must be knowing what liquidity is, how liquidity is created, and how you can maneuver around the liquidity. How you can maneuver around the liquidity and go past it. That is some of the important aspects in liquidity, because the market is ever hunting for liquidity. The market is ever hunting. And I normally tell people that liquidity is what drives the market. Liquidity is the lifeblood of the market. Without blood in your body, you won't be able to survive. So you need the blood. And the same thing with the market. The market needs liquidity to drive it. And after liquidity is taken, the market will move. And for the liquidity to be created, the market needs to induce people. If the market wants to sell, it will first buy. And in that process of buying, it is taking out liquidity that it needs to drive it to its original direction. So that is one of the things that you must be able to learn it before you become that good in trading. It is very, very important. It is a very, very important concept. So I think if there is no other further question, we have to proceed with our class today. And I've liked the turn up of today. Today the turn up is okay, and I think the turn up is okay because of the timing. I see we have Richard here. The turn up is okay because of the timing, I think. And that is why from the 1st of next month, the class will be there at 9 p.m. At 9 p.m. Yes?
Hello, Ambrose, and good evening, everyone. I'm glad to be here. Yes, please. It's a very interactive class, and I'm very glad that everybody is following. And from the submissions, I think we are doing great. Thank you. All the best.
Yeah. So I think we also have to welcome Fiona in the live session. Fiona, you're welcome.
Thank you, Ambrose. Thank you so much.
I know you always have questions. You ask a question before we begin.
The only question I wanted to ask is, okay, I had someone talking of retracement before the what? Before the price like reaches the what? Our zone. Yet I always see like retracement in most cases happens when it breaks structure, it reaches the zone, it passes Calito, then it retraces back. Then it continues in that same direction. So I'm a bit confused there, because he was like, it happens, it just reaches the zone, but then it retraces back, then it continues. That inducement happens, then it continues. But to me, in most cases, I feel like when I take my trades, it reaches the zone, fixes it, then it retraces back or induces, then it continues in the same direction. So I'm a bit confused there. I want some clarity from you, Ambrose. That is the question I can ask for now.
So are you seeing this setup that I made here?
Mm.
And you can see that we had 2 zones here, and the market reached the first zone. The market reached this first zone hours here. So when it did reach the first zone, you see it induced people into the market, and people entered. Then now it went to the extreme zone. So the inducement that he was talking over, if we have a point of interest like this, if we have this point of interest like this, what the market normally does, it will be forming a higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Then before it reaches our point of interest, it will start to move in the direction that you want. Because right now you have the supply zone, and you want the market to sell from that zone. Everyone wants the market from that zone, and everyone is trying to look at that zone. So when the market reaches a bit here, they will sell like this. But then the person who will do this is majorly someone who doesn't know market structure, someone who just someone who just spreads looks at the supply zone and wants to sell from the supply zone. And this scenario also comes, the scenario of selling before the market reaches your zone also comes with a fear of missing out. Because a lot of people, once the market reaches around here, they will start fearing to miss out. And fear of missing out, FOMO, is what normally kills a lot of traders. So you'll enter from here thinking that the market is now moving to your direction without you. Yet in actual sense, we have gotten a break of structure. We have gotten a break of structure that is here, and the market needs to retrace to a point of interest that is here before it goes to our supply zone right here. But in most cases, the market has a tendency of creating the double tops, double bottoms, something that a lot of traders are trying to look at. And like the way my friend from Nigeria, Mr. Lu, tried to explain it, the market normally likes to create double tops, double bottoms around here. It will create for you a double top around here. And when it creates a double top, people will start to enter the market. They'll now think we have resistance. They'll think the market has failed to hold this area. So they will think of this as the resistance. Yet in actual sense, the market is just trying to create some liquidity. The market is trying to create liquidity, like around here. The market is trying to create liquidity for it to take out and move in the right direction. So in most cases, the market will always induce you again. The market will reach this trend line and give you some sell moves then after it will take you out, react on this and drop out. So this is some of the liquidity concepts and liquidity concepts combined with inducement. Liquidity combined with inducement. So you always have to look at that area, that supply zone that you're eyeing at. You have to follow, or you have to observe the price action in that area. You have to observe the price action happening before your point of interest. If you have something like a double top, you have something like a double bottom, something like a rising flag, you have something like a marabuzo. A marabuzo, in simple terms, it is a head and shoulder. If you have those patterns forming before your point of interest, just know that is an inducement that the market is trying to form, and you have to be very, very conversant with that. So Fiona, you are saying first try to re-explain your question again, because I never got it. Yeah,
I was like for example, the market is in a bearish trend.
like
Now there's that zone, there's that supply zone that you've marked down, where the liquidity is. Now the price reaches, the price is on trend, It's
Yeah.
bearish.
Yeah.
Then there is that supply zone that you've marked down where the liquidity has generated. Actually, a supply zone, you identify it down, then you mark it. Now, the price comes and passes this supply zone. You're
This is the
getting me?
supply zone. So this is the supply
Yes.
zone. So the price comes and passes it.
It passes it down. It continues selling down, but then it won't go for so long. It will just pass it a little. Then it retraces back up to somewhere there. After
Around here.
retracing it, yes, it retraces back. In fact, it will retrace back again beyond the supply zone. It gets back inside, then it continues selling on the bearish what? It continues on the bearish trend actually. But I had the mother explained that price comes, it tries to actually it doesn't go beyond the zone, your zone, then it induces back, then it continues on that very direction. That is where I was a bit kind of confused. Have you got me, Ambrose?
I wish you could pass
Okay,
your screen the way you are explaining it. I never got it well. But according to what I've understood is you're trying to try to confuse liquidity and market structure. Like that. That is what I've maybe tried to get, but I haven't understood your question very well. According to what I've understood is that the market will come and pass your supply zone like this. Then after it will start moving again to your direction.
Yes.
That's what I've understood. Like that.
No, it won't even move. It won't even move like how you've indicated here. It will just come back a little, then it continues. You've understood? Yes,
Like
somewhere there. Yes. Somewhere there, then it continues. Yes, like that. Exactly.
Now that one I've understood you now perfectly. So the thing is, we're trying to confuse market structure and liquidity. So like the way I was explaining, liquidity is the most important concept. So the market structure can be violated with the aid of liquidity. That's what you have to know. So this is the scenario that normally happens. We have the market giving us lower lows and lower highs, like these lower lows and lower highs. So when we do have lower lows and lower highs, we have this supply zone right here. This is a supply zone right here. Then we also have another supply zone above here. So we have two supply zones around here like this. So we have a break of structure that is here. There's a break of structure here. Then we also have another break of structure here. The break of structure here. So here we have two concepts here. We have liquidity and market structure. The market structure is clear that it is bearish. The market structure is very clear that it is bearish. Am I clear, guys?
I'm getting.
Yeah, it's
The market
bearish.
structure, it is clearly that it is bearish. But then remember we have a supply zone that is above. And the supply zone that is above is what I call a left order. You have a left order that is above. So when you do have a left order that is above, the market has a tendency of if there's a left order that is above, the market has a tendency of going above this level. So if the market goes above this level and reacts on this, we have two options here. The first option is that either the market has come to react on this left order, which it has done, or the market has come to clear some liquidity that is above here. Let's give this scenario that we have liquidity, because normally when the market goes above that, it is trying to create some liquidity. Like let's say the market won't always just pass this level like this. At least it will give you an inducement. Like I normally say, it will give you an inducement around like this. Then after it goes past it. So in that process of giving an inducement, it has created liquidity. So in the process of creating liquidity, it has created liquidity and taken that liquidity. It has created liquidity and taken that liquidity, which will generate its move. So once the market closes above once the market closes above this level here, once there's a market closure above this level here, what you do have to understand is that we have two options here. Either the market is coming to clear liquidity, which it has cleared liquidity, or the market has changed trend. So for you to confirm this, if the market goes above this swing, because this is a swing, this is a swing high, this is a swing high, and this is a swing low right here. If the market goes above the swing high, what you have to know is that either the market has changed or we are trying to sweep liquidity. So what you can use as the confluence, you look at this area here where it is happening. You first go to the higher time frame, like the H4 time frame. We first go to the H4 time frame to see where it is happening from. Where is it happening from? If it is happening at a demand zone on the H4 time frame, if it is happening at a demand zone on the H4 time frame, then we can assume that the market structure has changed. But if it is not happening at a demand zone, then it is a liquidity sweep. If it is not happening at a demand zone, then it is a liquidity sweep. But if it is happening, then the structure has changed. And if it is a liquidity sweep, the market will react on this left order. Then after, it will continue moving to the original direction, clearing this swing low here. But if it is a shift in structure, and it is happening at a demand zone, then we shall have the market react on this. We shall consider this as a break of structure right here. We shall consider this as a break of structure right here. So having gotten that break of structure, we shall need the market to retrace to our points of interest that we may be having below here. So assuming we have points of interest below here, we shall assume that the market is coming to retrace to that point of interest that we do have below there, and we continue with our upward market structure move because it has reacted on a demand zone. So having got a demand zone like this, we now need the market to move to the upside. So when that thing happens, you check on the higher time frame to see where the market is reacting. Is it reacting at a demand zone that will push the market further higher, or is it at a random area that is just trying to clear liquidity? So if it is at a demand zone, reacting at a demand zone, we shall need to look at the points of interest that we have below here. So expecting the market to react here, and we move to the upside. But we can also trade this. Reason being, this is a left order, and this left order, we shall use it as a retracement. We shall take it as a retracement like this. Then we come to this area, then we can push to the upside. So if such a scenario happens, look at the higher time frame narrative. Look at where the market is at that time. And you try to think of it in that way. So guys, Fiona, am I clear on that?
Yes, it's clear. It's clear.
I've got you.
Yes, Ambrose, I wanted to ask some question. You have brought a very important concept over there, and I would request you maybe to just show us that very thing on the real chart, so that we able to identify it very well.
Okay, let me show you there on the chart. I think today the lecture we are supposed to have, that is the entry models. We may even have it tomorrow, because now we are trying to digest something here. Let me share my screen. Let me look for an example here. Let me look for an example here. Let me get the live example. So looking at this is an EU setup that I made, and you can see the way EU moved. EU gave us some sell moves, like from here, from this area here, I got a sell move on EU up to around here. And this was to take my profits even already. Because normally in trading, if you have good risk management and you know how to manage your money well, it will be good for you. So like this, the market moved up to around here. So when the market moved around here, this is a risk to reward of 4.56. That is approximately 5. That is approximately a risk reward of 1 to 5. Mr. Joshua, are we good on this? Are you following?
Yes, I'm following very well.
So the risk reward of this was 4 to 5. 4 to 5. That is approximately 5 on this, and it was a good one, because for you to be successful or for you to be profitable, you need a risk reward of 3. A risk reward of 3, it's good. So this move happened. So after the market sold, after this EU setup sold up to around that area, it decided to move above. So when it does move above, what you do is you go to the higher time frame, and we see where the market was at. So now I want to see where this area was. This area here was where the market was reacting from. And before that, we have seen that we have had a candlestick body closure. You first look for your swing high. And swing low. Where do we have the swing high and the swing low? That is what you have to first identify. And our swing high, it is this area here. This is our swing high. So the market has closed above our swing high after giving us some movements. Now it closed above our swing high. So this is what we have right here. We have this. We have this. That is a swing high. The first time the market never closed above it. The first time we never had a market closure above this area. It was just a liquidity sweep. So now let's look at this area here. Now here we have now gotten a market structure. We have gotten the market that has closed above it. And this was a clear closure, because we have the first one was a liquidity sweep. Having gotten a liquidity sweep on the first one, the second one, the market closed above it. We also had another market closure here, another one here. So this was a clear market. This was a clear candlestick closure above that area. So having seen a market closure above that area, what you do is we get out our Fibonacci tool and we measure from the lowest point here until the highest point that we have here. Until this. So having gotten until that, we mark our 50% zone, which is around here. This is our 50% zone around there. So we expect the market to come up to around this 50% zone of ours before we can think of buying. But then, like I told you, we have to go to time frame to see where this market is reacting at. Where the reaction is happening at. Where is this reaction happening at on the higher time frame? If it is happening at a demand zone, then we shall be certain. If it is happening at a demand zone, then we shall be certain that the market is shifting. The shift is it's right. So we go to the higher time frame, that is the H4 time frame, to see what we do have right there, where the market is reacting. At. So looking at this reaction, the market came and reacted on this area here. This is where the market came and reacted at. So we shall look at it on the other side. This is where the market reacted at, on this level here. So we see that we had this imbalance here. Then we have this candlestick here, and this candlestick will be like our demand zone. Though the market closed above that, that will be our demand zone right there. Then we also try to zoom. We also try to zoom in. We also try to zoom in and zoom out. And we see the market direction, where the market direction was. We had a break of structure here to the downside. We had this. We had this. Then we had this break of structure here to the downside, like this. Then we had this mitigation. We had another break of structure here to the downside. Then, having got a structure to the downside, we can see that the market came and went above this level. Above, this was our swing high. The market came and went above our swing high and reacted on a point of interest that is here, that is above here. And this point of interest right above here had some liquidity. Had some liquidity right above here. We had some liquidity here, and that's why the market came and reacted, went above it, took out the liquidity, and it tried to move to the downside. But remember, before it moving to the downside, we had this swing high that was broken. We had this swing high that was broken right here. So we shall consider this as a break of structure. We shall consider this as a break of structure. This is a break of structure. So when we do get that break of structure, and the market, we expected the market to come and react on this and move to the downside. And you can see this reaction. The market reacted and moved to the downside. So when it did that, we see that liquidity was generated. We had another liquidity that was generated. This is an inducement. This is an inducement. Like the way I was telling Fiona, that the market will always induce you before, at every point of interest. You'll always get an inducement at every point of interest. So now here we have gotten an inducement. So having gotten an inducement, the market went above it and broke above it, like the way Fiona was trying to explain. But we had another point of interest that was above. This was a left order that was above here. And this left order that was above here managed to push price further lower. And when it did push price further lower, it failed to clear this. It failed to clear this, and after it went back to the upside. I think this is the perfect explanation to what Fiona was trying to. The market comes and clears. The market comes and trades above your point of interest. Then after it fails to clear the low that is below. Then after it starts to move to the upside. So when it goes above your point of interest like this, you have to start looking for the points of interest that you have below. So now, which points of interest do you have below? And the points of interest that you have below must have liquidity. That's why you saw me marking. You saw this liquidity here marked. And when this liquidity here was marked, I looked for the point of interest that was below. I looked for the point of interest that was below that liquidity. We had this liquidity, and the point of interest that was below, I saw we had this imbalance. We have this imbalance that is right there, and I marked the point of interest that we have below here. So I marked this point of interest. I marked this point of interest right here, and I wait for price to come and approach it. And you can see price came and approached it, and it moved away from there. It came, approached it, and it moved away from there. And this was some good pips, because if you take your entry from here up to around here, it is some good one. But here we also expect a reaction. We also expect a market reaction. Yeah, the market reaction has to be there, because remember we also have this internal break of structure. We have this internal break of structure right there, and that internal break of structure, we have an imbalance here. We have an imbalance. Then we mark the candlestick that is above. We mark the candlestick that is above, right there, and we need some reaction right there. If not a reaction, if not a reaction, then it has to be some massive impulsive move that is maybe coming to react to one of the zones that we have here. So right, we're having some market reaction right there, and if you are to go to the low time frame, that is the minute 15, we need to see we do need to see we do need to see something like a shift in structure right there. We do need to see a shift in structure right there, like a break of this. Then we come to the downside, we mitigate, then we continue moving to the downside. That is what we do need to see there on the minute 15 time frame before we can think of taking any action. And you can see that it already happened. It already happened even. It has already happened. It has already happened because we have this. This is a high. This is a higher low. This is a higher low, higher high. This is a higher low. Then we have a higher high. Then we need this level here to be broken. And looking on the left, it has already been broken. So we need that level to be broken. So we have that break of structure right here. So the break of structure has already happened here. So we have that break of structure. What we need right now is that we need the market to retrace to our points of interest that we have above. We need the market to retrace. So now, which points of interest do we have above there? The point of interest that we have at the extreme, we have this imbalance here. We have this imbalance, so we need to look at this. We need to look at this. We need to look at that here. And that area has liquidity. Guys, if your mic is on, please mute, because I'm getting a lot of feedback. If your mic, please mute. I'm getting a lot of feedback. Thank you for that. So we have a point of interest that is above here, and we need that will be a perfect area there where we can take our sales from. Because now we had this, but this was mitigated. It was mitigated. Here, there is no sufficient price around here. Everything is sufficient. Then here, there's nothing that we are looking at. Then maybe here we have another zone right there. Maybe we have another zone right there. So basically, we have two zones, and that zone has liquidity resting right here. So you can see on the H4 time frame, the market approached our zone. Right now, we have gotten a shift in structure. So what we do need is a mitigation to either here we drop down or another one on the upper at the extreme. But remember, EU, then we maybe another one from here, then we drop down. So this is what we have on this EU setup. This is what we have on this EU setup. And I think I've tried to digest Fiona's question and the other person who asked. I think I've tried to digest your question. I've tried to answer your question. Today we are meant to look at entry models, but you can see we have taken more than enough time on trying to answer some of the questions. But entry models needs a lot of time. For us to digest, because it is a full thing. So I think we shall discuss it tomorrow. Then the topic which was supposed to be discussed tomorrow, that is time frame alignment, we shall push it to the next time. Yes, bro. Yes.
When you are doing analysis, you used to say when you say a fair value gap, then the next candle above it, if above it, is your supply zone, right?
Yeah.
Now my question is this: I basically show interest more in ICT. Now, when you say that after the fair value gap, the next candle is your supply zone. It's your supply zone. Then what of a situation after the fair value gap, the candle on the, because to me, I usually take the last bearish candle before the downward move as my as my supply, as my order block. I use order block. What is it?
So,
I use order block. You understand what I'm saying? But sometimes if you say that after the fair value gap, the candle above it is your supply zone. What if that supply after that candle does not conform with the other block? What do you do?
first of all, according to the way I've understood your question, always another block is the last opposite candle that breaks structure. That one you must know it. And that other block of yours, must be a full-bodied candle for it to hold price. And that other block of yours must not have liquidity above it. Because if it has liquidity above it, it will not respect. And we have 7 institutional reference points. We have 7 institutional reference points that you must know. It's not a must that price must react on your demand. So the market has 7 institutional reference points. So it can react on the mitigation block, it can react on the supply zone, it can react on the demand zone, it can react on an institutional order block, it can mean to go to your order block above or the rejection block. So where you get a confirmation from, you take the trade. You see, our major motive is to take small risk and we get something that is kind of bigger. So always do not only look at the order block that is above. Then the other thing is also depends on the pair that you're trading. You must know the characteristics of the pair that you're trying to trade. Because we do know that gold likes the extremes, and gold is ever normally reacting at the order blocks. The pound pairs, the GU, the GJ, those pairs, that they also normally react on the extreme points of interest. But we have pairs like the EU, the AU, the NZD. Those pairs, they like reacting at the intermediate points of interest. So that one also brings me to the point of understanding what you're trading. You must understand what you're trading and where it reacts. And for you to understand what you're trading and where it reacts, you need to backtest. You need to make enough backtest. And with backtesting, you will get the confidence and everything. So you need to backtest to understand where your price is reacting. We have, I think I've seen the best artist in Lira in Northern region. The best artist in Northern region, Brandon Peanut. Today you're around. Brandon Peanut, the best artist in Northern region today. Brandon Peanut, you're welcome.
Yes. Thank you. I don't know if you can hear me. I'm on AirPods.
Yeah, we can get you. We can get you.
Yeah. Okay.
So, Mr. Peanut, last time we discussed the GJ setup, because for you, I know you like trading the GJ so much. And the last time we discussed it, the GJ had 2 points of interest. Let me show you right here. GJ had 2 points of interest. And
okay.
Like I said, the pound pairs, they normally react at the extreme. So GJ had 2 points of interest. And let me share screen here. GJ had 2 points of interest right there. So I normally tell people that the pound pairs like reacting at the extreme. You can see the inducement. This was the first point of interest right here. You can see the inducement that this GJ offered right here for it to go back to the zone that is above. You can see the inducement here. So normally, once you get a shift in structure at your point of interest, you can take the trade. But remember to manage it. That's why I normally say make your stop loss to be 3 to 5 pips. 3 to 5 pips, because you will lose small. But in case you are to win, you will win big. But just know you have to manage your risk and you manage your money. So here, DJ induce people here. But if you had entered the market and you know how to manage the risk management and money management well, you take a small loss around here. This is a small loss, like with 3 to 5 pips, that is around you'll even lose less than $1. But now when the market reaches the extreme point, which we know that the pound pairs normally go at the extreme point, here you enter your positions here, then right now you would have recovered everything, because now you see this market movement right up to around here. Let me try to see how far it has gone. So Mr. Brandon Peanut, you can see this is how far this GJ has gone. And this is more than enough for you to be profitable, because this is a 3.96, approximately 4. I've gotten a risk to reward of 4. You're risking $1 to make $4. This is what it has so far given you. It has so far given you, but we expect it to drop further down here. So you can see, my people, always and always try to risk small and you win big. Try to study the setup, the pair that you normally trade. And I remember Mr. Brandon also told me that he had entered this setup, but I don't know whether he feared and he got out or something like that.
No,
Because he was
what I said and my analysis, it gave me my profits where I wanted it to stop. Yeah, sometime back actually. I placed the trade for like a very few moments, like 1 hour. My whole take profit was taken, and I was really happy about that today.
Now you see, he took his profit. Yeah, so?
Yeah, so I think tomorrow I'll wake up and get another setup, but I know it's going to be a sell somewhere there, and I'll enter again. And that is how I do my trade. I don't really go for that long time.
So that the trade that you'll get tomorrow must be a sell, and the sell must be a re-entry. Like here, if someone wants to still enter this GJ setup, we have a break of structure, because you can see that we had a high, we had a higher low, we had a higher high, we had a higher low, we had a higher high. Then the market came and broke this area. So what do we need? We need a retracement. Then we can get some re-entries right there. So we need at least a retracement. Let's see the zone that wasn't touched. We have this zone. We have this zone that is above that wasn't touched. We have an imbalance here. Then we have this zone that wasn't touched. But this zone, it is a left order. Reason being, the market moved at least 50%, because if you are to measure from here until around here, like this, the market moved up to around 50%. And the re-entries, the first re-entries was around somewhere here, because the market moved around 50%. So we have gotten some re-entries. So the zone that is above, it is like a left order. In case the market is to come back to it, you should not hesitate to take that trade. You should not hesitate. Then we also have another internal break of structure around here and around here. So we have this imbalance that was around here. So we could also look at the trade. We could also look at this zone right here. We also try to look at another zone that is above here. So basically, trading is all about managing your risk. So now looking at someone who took at least a trade from here, someone who took a trade from here, looking at it on the 1 minute, if they have already hit the 1 to 3 risk to reward, if they already hit it, we have this. We had this. The market reached our zone, gave us this. Then we had this. We needed the market to break this, and it did break that. So we enter the market when we enter the market on a retracement up around the 50% retracement right here. Then we have stop loss kind of above here. This one was kind of, the stop loss was kind of big, but we put it around there. Then we try to target what we have below. Try to target what we have below right there. And right now, the market hasn't moved that much, but it is moving, but it hasn't moved that much. So that was some re-entry around there. So this is, so far the market has given us 1 to 2, which some traders could even take, because we have those traders. Some other traders, they don't hold their trades for long. So we could that. So you can see how strategic you need to be. You need to be very strategic in the market. You can see how Mr. Peanut entered with this setup, and now he has made the money and is out. And he's going to use the money for something else, shooting a music video or releasing a new music video. So we have to be strategic in everything that we do. So this was the GJ. This was the GJ setup. I sent this GJ setup, was it on Thursday or Wednesday, around there? And those who took it serious, like Mr. Peanut, he managed to get something right there. So, like I was telling you guys, on the 1st of Feb, not Feb, of March, that is some weeks from now, I'm starting a VIP channel. That is the VIP signal channel, and in that VIP signal channel, there will be guidance. There will be guidance. I'll be guiding people on when to get out or when to enter, and the signals will be dropped like 3 to 5 signals a day, 3 to 5 signals a day. Guidance, we shall be having live sessions, like once the setup is about to form or give us confirmations, I will organize a live, and we try to digest it, and we see how to enter it. So there will be a lot of things happening in that VIP signal group, and we shall be having our mentorship classes at 9 p.m. because I know from 9 p.m. onwards, everyone is home and they are settled. So that's why the turn up is good today, because the timing is okay. So the classes will be at 9 p.m. but our daily interactive VIP signal will be throughout the day from 9 a.m. onwards. We shall be having it. So those who are interested in the VIP signal, you can inbox me. You can inbox me right away after here, and it is just $15. $15. That is like around 55,000 shillings. That is a good price, because now what we are going to do is going to be kind of massive. The mentorship class, we have maintained it. The mentorship class, for those who are willing to join, or you have friends who are willing to join, the mentorship class, it is $55. That is 205,000 only. It is very cheap. Other mentors charge $100. That is around 370,000. But my mentorship is just $55. And the mentorship, from next, like the way I posted it in the group, from next week, I'll be restricting the entry of new members. We're almost having enough members, and I want to concentrate on the members I have, and the signal group that is beginning on the 1st. So if you have a friend who hasn't yet joined the mentorship, tell them we have the mentorship class, which is at $55. That is 205,000 Ugandan shillings. They can join, or they can inbox me, and we try to negotiate about it. We talk about it. But for the VIP signal group, it is $15. That is 55,000. You can join, and you experience what we shall go through, starting on the 1st, effective on the 1st, because by next month I'll be very free. I'll be very, very free. So basically that is what we had for today. And our next class, today we are meant to discuss about entry models, but you can see what came up. A lot of questions came up, and we ended up discussing such. But tomorrow we shall have the entry class. Then the entry models. Then after tomorrow, the day after tomorrow, we shall have the class which we were supposed to have tomorrow, which is the time frame alignment. Then towards the end of the week, we shall have that one is an interactive session, like the way we interacted last time. And last time we had our discussant, which is Mr. Joshua Odida. We have to appreciate him because he did a lot of work on that day. So make sure you're ready to discuss once I maybe choose you. And next week I was planning to give an examination, an exam test to try to access what we have so far learned. So basically that is it. That is what I had for today. Those who are interested in the VIP channel, like I said, the VIP signal channel, it is $15, and it is limited to 15 members. So if you join, if you have reached 15, I'm also going to close it. So basically that is what I had today. In case of any questions, you can inbox, and if you have those questions, also you inbox me with those questions. We shall answer them. So guys, I normally tell you guys, just practice. Make enough practice. That is what I had for today. I think any other questions before we call it a day? Any questions? Any reactions?
Ambrose. Hello, Ambrose.
Yes, Mr. Olu.
While practicing today, I sent you a setup to help me confirm the validity. There was no response.
The validity?
Yeah, can I share the screen here now?
But this time, if you're sharing screen, make sure you're sharing not a screenshot, because for you like sharing screenshots. Okay, you can
sorry.
share.
Okay, thank you.
Share. Okay,
hello.
Yes, we are seeing your screen.
Can you see my screen?
Yeah, I'm seeing your screen. Let me stop sharing. Let me stop sharing mine, and I let you share yours. Let me stop sharing mine.
Stop sharing.
Yeah, I've already stopped sharing. You can now share yours.
Okay, I've shared the screen. Can you see the screen?
No, your screen isn't visible. It has frozen.
Huh?
Are you using
Okay.
if you are in Nigeria, I would say if you are in Uganda, I would say you're using like.
It's breaking. Sorry. I will stop sharing. Okay. Don't worry. I'll send it to your WhatsApp, please. It's not clear here. The voice is not clear. Thank you. Thank you. Hello. Hello.
Yes, I'm getting.
I said I can't. I'll send it to your WhatsApp. No problem.
Pardon?
I'll send it to your
Okay,
WhatsApp.
it's fine.
Then
You send.
it's not clear, so that I will not waste your time there. Thank you.
It's fine. It's fine.
Okay,
So, Mr. Fred Mugabe, thank you for joining our class today. Today, I know it's your first time to join us today, but next time it will be fine. Any reactions?
No, I think we are fine for this night.
Let us get a closing remarks from. Let me see. Closing remarks. Let me see who can give us a closing remarks today. Or we can get Mr. Peanut to first sample us his song today as a closing remark. Mr.
Indeed.
Brandon, you sample us your song as a closing remark. I think that would be better, because now here we are trying to promote your song. Now, a person in Nigeria like Mr. Olu, you also try to play the song there. We need to grow.
And I can also take it to Teso.
You take it to Teso. No, for you take it to Teso, but also we have prisoners there in Tigo prison where you are. You can also play it to those prisoners. Not that they have no choice. They have to listen to it. Brandon, you are waiting. I think Mr. Brandon is busy. But anyway, guys, let us let us call it a day.
Thank you very much. We appreciate it.
It's fine. Let us meet tomorrow. Guys, have a nice day. See you when you see me.
All right, thank you.
Thank you. Bye bye.